Yeah, good afternoon. Good afternoon. Last class we discussed about ratios, fund flow statement, cash flow statement, explanation, and pro forma. We discussed about that. And problem of fund flow is also we explained that. Then today we discuss about cash flow statement. Cash flow statement is one of the important techniques of analysis of financial statement. Here, the problem on cash flow statement. Yeah, from the following activity of X Limited for the year ended 31st 3 2015, compute net operating activity. Then this is the information. X Limited made a profit of rupees 1,85,000 after considering the following information: depreciation on fixed assets 5,000, profit on sale of building 10,000, loss on sale of machinery 4,000, provision for taxation 30,000, then provision for doubtful debts 500, then transfer of general reserve 12,000, goodwill written off 2,000, purchase of investment 20,000, sale of plant 30,000, issue of shares 10,000, redemption of debentures 15,000, purchase of plant and machinery 60,000. Then the following additional information is also given: debtors 2 years information, 14 information and 15 information, because cash flow statement it tells about we need that fund flow and cash flow 2 years information. Yes, here debtors 2014 18,000, 2015 17,000, creditors 2014 12,000, 2015 9,000, bills receivable 2014 7,000, 2015 4,000, then bills payable 14 3,000, then 15 3,500, outstanding expenses 4,000 2,000, prepaid expenses 2,000 2,500. This is the problem of this type of problem they may ask in the examination. With the help of these informations, that is fund flows, cash flow information, we need to prepare here three activities. In theory, we discuss about that cash flow from financial activity, financing or financial activity, cash flow from investing activity, cash flow from investing, then financing, financial, and financing. Yes, under that cash flow statement as per accounting standard 3. This is the standard we are using. Presently, they are practicing, the companies here, they are practicing that accounting standard 3 cash flow statement. And the first one, that is cash flow from financial activity. Last class, we discussed about, while discussing theory, what are all the probable items that is appear in the financial activity, financing activity, and investment activity. We discuss about that here. In this problem of cash flow problem, net profit before tax that is available in that balance provided in that X Limited made a profit of rupees 1,85,000 after considering the following information. Yes, that is net profit before tax. That is we call it as 1,85,000. Outer column, inner column, as per cash flow statement accounting standard 3 AS3 particulars, the inner column and outer column. That is the situation. Here, first Add that cash flow from financial activity, add net profit before tax, add non-cash and non-operating expenses. We need to add non-cash and non-operating expenses. Depreciation on fixed assets. See that depreciation. Before that, you can, while preparing trading and profit and loss account and balance sheet, left hand side, we mentioned that what are all the first category, second appear in trading account T, and the transactions related to P and L, then transaction related to B, balance sheet. That type of, that is also, if it's easy to, if you mark left hand side of the pencil, use that pencil, and left hand side, if you mark that, after that you can erase that, because question paper, that is, you should not use that. But before that, while practicing, while solving the problem, this is most important. Yes, non-cash item, non-cash and non-operating expenses, that is depreciation on fixed assets, that is a non-cash and non-operating incomes. Depreciation, why we charge depreciation? We charge depreciation to replace existing asset, therefore we are charging, that is, we call it as a non-cash or non-operating expenses, that is coming under non-cash and non-operating expenses. That is depreciation on fixed assets, inner column 5,000. Then loss on sale of machinery, that is also non-cash and non-operating incomes, non-expenses. Loss on sale of machinery, that is 4,000. Then provision for taxation, provision we call it as that is one of the portion of the profit. Provisions and reserves and provisions is a portion of the profit. Therefore, in that context, provision for taxation 30,000. See, where is that provision for taxation? See, provision for taxation 30,000. See that in X Limited made a profit of rupees, that following information, in that information we see that. Then next one is provision for doubtful debts, that is also in the additional, that is following information 500. This is also provision for doubtful, this just we create in case of credit sales, doubtful, the debts, that is doubtful, therefore we call a we made a provisions, because if it is credit, if the organization go for credit sales, that is debtors is common more than 95%, 90 to 95%, that is in credit sales. Therefore, in that context, that is debtors and provision for doubtfuls and reserve for doubtfuls, that is quite common in business organization. In that context, that is provision for doubtful debts, that is also 500. Then transfer to general reserve, this is also transfer to general reserve. Why we create general reserve? To face the unforeseen situation in the organization can face any challenges, any, because theft it may happen, or fire it may happen, anything it may happen. Therefore we create general reserves to maintain the business as usual. General reserve, that is transfer of general reserve, transfer to general reserve 12,000. Then goodwill written off, these are all depreciation of fixed assets, loss on sale of machinery, provision for taxation, provision for doubtful debts, transfer to general reserve, goodwill written off. These are all the non-cash and non-operating incomes. Non-cash and non-operating incomes. Okay, that is goodwill written off 2,000. You better to write mark for those items, those information, that is if you considered in that FAT category, cash flow from financial activity. Okay, here no other items that is available in non-cash and non-operating income. Therefore total 53,500, that is non-cash and non-operating expenses are 53,500. Therefore in that connection, yes, here 1,85,000 minus 53,500. This is add or left. Add to that net profit. That is 1,85,000 plus 53,500. Non-cash item, you need to add that. That is 2,38,500 non-cash. and non-operating income. The next category is less deduct, less non-cash and non-operating incomes. We need to add profit before tax. What is that? Net profit before tax. We need to add non-cash and non-operating expenses. Then deduct or less non-cash and non-operating incomes. Then there is first category, that is profit on sale of building. Only one item that is available in our problem, that is profit on sale of building, that is a non-cash and non-operating income, that is inner column 10,000 rupees. Then outer column 10,000, deduct from this 2,38,500, that is outer column is if you deduct 10,000 non-operating incomes and non-cash and non-operating incomes from these net profit plus non-operating expenses or non-operating expenses, that will find that the first category 2,85,500 that is available. Then under that second thing is, because in case of fund flow statement, that is schedule of change in working capital, decrease in assets and increase in current liability. Then increase in current assets or decrease in current liability. That is schedule of change in working capital. We are work out that. But in case of this cash flow statement, here under that A, that is decrease in current assets. Debtors. See the 2 years balances that is provided. That is 2014 and 2015, 2 years balance are there, because these are all debtors are current assets. Current asset, decrease in current assets. What are all the current asset that is decrease, we need to consider here. Debtors 18,000 minus 17,000, that is 1,000, that is decrease current assets. There are another assets, bills receivable, that is 2014 7,000, 2015 4,000. Therefore 7,000 minus 4,000 is equal to 3,000. Then B, increase in current liability. What are all the current liability that is increases? We need to consider here. Creditors 12,000, liabilities 12,000 in the first year, and the second year 9,000. Therefore 3,000, that is increase in current liability. Then outstanding expenses also 4,000 in the first year, and in that is increase in liability 2,000, that is also 2,000. Total is, that is total of decrease and increase in current liability, total is yes 2,28,000. Add this one, add both this decrease in current assets and increase in current liability. We need to add here 3, 6, 7, 8, 9. Yes, 9,000. Add that 9,000 here. That is decrease in current assets and increase in current liability. We need to add here 9,000. The total is 9,000, 1,000, 3,000, 4,000. Here is also 3 to 5. 5 plus 4, 5 plus 4, 9,000. We need to add 2,28,500. Add 9,000. That is 2,37,500. This is, we call it as an cash flow from financial activity. Cash flow from financial activity. Cash flow from financial activity, that is rupees 2,37,500. Then less, that is increase in current assets and decrease in current liability. Under that A, increase in current assets, that is prepaid expenses, that is increases 2,000 and 2,500, 500, that is inner column. Then depreciation in current liability, that is bills payable, that is decreases in current liability 500, total 1,000. This also we need to deduct 2,37,500 minus 1,000 is equal to 2,36,500. This is regarding cash flow from financing activity. The next one, second category, cash flow from investment activity. This is the second category, cash flow from investment activity. Here Purchase of investment 20,000. Sale of plant 30,000. See that purchase of plant and machinery 60,000. Here within bracket, that is cash flow from cash flow, because purchase of investment cash goes out from the organization, therefore that is in within bracket. Sale of plant, the cash comes into the organization, therefore without bracket. Then purchase of plant and machinery 60,000, that is 60,000 goes, cash goes out from the organization, therefore 1 minute. Hello. Yeah, that is within bracket, that is cash goes out from the organization 20,000, purchase of investment and purchase of plant and machinery. If you add that purchase of plant, cash goes out from the organization, purchase of investment, cash goes out, then purchase of plant and machinery, cash goes out 80,000. Then sale of plant, cash comes into the organization, that is 80,000 minus 80,000, 80,000 cash goes out from the organization. Then 30,000 cash comes into the organization, that is 30,000. That is 80,000 minus 30,000, 50,000. Here cash flow from investment activity is, that is 50,000. We need to deduct that 50,000, that is within bracket, that is cash goes out from the organization. In final cash flow for investment activity, cash goes out, that in the tune of rupees 50,000. Therefore 2,36,500 minus less, that is 50,000, cash goes out from the organization for investment activity, that is 2,36,500 minus 50,000 is equal to 1,86,500. Then lastly, this is we call it as a cash flow from investment activity. Then last category, cash flow from financial activity, financing activity, financial activity. Then here issue of shares, cash comes into the organization, redeemable of redemption of debenture shares, that is also 15,000. Redemption of debenture, issue of shares, cash comes into the organization. Redemption of debenture, cash goes out from the organization. Debenture, if you redeem the debentures, we need to pay, company has to pay, that is 15,000 to outsiders, debenture holders. Therefore here 15,000 minus 10,000, that is 5,000. Cash goes out from the organization 5,000, that is from financial activity. Cash is also goes out from that organization. Here 1,86,500 minus 5,000 within bracket, that is cash goes out from the organization, because here in 15,000 that is missing, with bracket missing, you need to add that bracket in redemption of debentures, that is cash goes out from the organization. Here 1 lakh cash from investment activity, 1,86,500 minus less 5,000, cash goes out from the organization 5,000, 1,81,500. This is we call it as cash flow from overall activity of financial, investment and in that is investment, financial and financing activity. This is about the way of solvation of, that is cash flow statement. This type of problem they may ask in the examination. These also from most important techniques used in the organization, any company or an organization, they are using in this. Yes, next I will move on to, that is marginal costing. One minute. Next I will move on to marginal costing. 1 minute. These slides are not uploading. Yeah. Okay. Yes. Okay. Costing, definition of costing and marginal costing. This is about the marginal costing. Definition of costing. The Institute of Cost and Management Account England, ICMA, has defined the cost. Yeah, the Institute of Cost and Management Account England, ICMA, has defined cost accounting as the process of accounting for the cost for the point at which expenditure incurred to the establishment of its ultimate relationship with cost centers and cost units. Here, it is an cost accounting. Cost accounting is the process. It is a process of accounting. Cost accounting is also one of the important techniques. Marginal costing and cost accounting. Cost accounting is also one of the most important techniques of that is accounting. For the cost for the point, here cost of that particular that is manufacturing unit, cost for the unit at which expenditure incurred, that is most important. Here the cost from the point at which expenditure incurred we can find out with the help of the cost accounting to the establishment of its ultimate relationship with cost centers and cost units. Establish the ultimate, what is the relationship between the cost centers and the cost unit. With the help of that cost accounting we can find out that. Cost terminology, these terminologies are frequently we are using, therefore these terminologies are most important. Cost means the amount of expenditure incurred on a particular thing. That is an amount. Cost is an amount of expenditure. Each and every transaction, that is an it incur cost. Amount of expenditure incurred in a particular thing, that is we call it as a cost. Then costing is a method. This is a process. Costing means the process of ascertainment of cost. It is a process. Costing means ing form. It is a process of ascertainment of cost. Then cost accounting, the application of cost control methods and the ascertainment of the profitability of activity carried out or planned. Cost accounting means it is an application of cost control method. System is there, cost sheet is there. With the help of the cost sheet, we prepare cost sheet. That is most important. How to find out what are all the contents, that is in manufacturing and other industries, cost sheets are most important. For that, in that application, cost control method and ascertainment of the profitability of the activity carried out or planned, that is we call it as an accounting, cost accounting. Cost control, it means control of cost by management. These are all the important texts. Management has to how to control the cost. Management has to take the appropriate measures to control the organizational cost. Any expenses for that matter, any cost for that matter, the management has to take appropriate control methods. Cost accounting system. There are four types of cost accounting system. One is job costing, another one is process costing, the next one is contract costing, the last one is service costing. These are all the four important costing systems are there. What is the meaning of job costing? What is the significance of process costing and contract costing and service costing? Job costing means the word itself says that here job costing, each and every activity having its own but job, that is job costing is a form of specific order costing, the attribution of cost to job, particular activity, particular job. Again, if job costing means it is a form of specific orders, specific order costing, the attribution of cost to particular activity or job. That is, we call it as a job costing. Process costing. Process costing is a method of costing under which all costs are accumulated. All costs are accumulated for each stage of production or process. Because you take an example in manufacturing process. Raw material to finished goods. There are, it may be 10 or 15 process. I don't know how many of you visited dairy. Dairy. If you go to dairy, that is n number of processes are there. N number of process are there. That is process costing process. Each process having its own cost. That tells about that process costing and cost per unit per product as a time at each stage of production by dividing the cost of each process by the nominal output of the process. Dividing the each process. For example, 10 process of that manufacturing process or any process for that matter. 10 stages are there. 10 stages if you go for raw material to finished goods. Each stage, first stage, what is the cost of that? With the help of this processing cost, we can find out that. What is the cost of the fifth process? What is the cost of the seventh process? What is the particular cost of the eighth process? We can find that. Then which process, which stage is incurring more expenses, we can find out that this is most important. Process costing is most important for, that is, any production activity, manufacturing activity, or any activity for that matter. Process costing is most important. The next one, contract costing. Contract, a form of specific order costing in which costs are attributed to individual contract. Take an example, any contract for the building contract, road contract, dam contract. That is, we call it as a contract costing. Each contract costing, each contract having its own cost. Because always, you take an example in road construction or dam construction. Today, the raw materials, it may be 5 rupees. Tomorrow, it may be 7 rupees. It may be next year, because the contract costing is the period. It may be 5 years, it may be 10 years. The cost, it depending upon the, that is, situation, depending upon the availability, it depending upon the, that is, time, the cost increases. Therefore, it may be 5% increase in cost, or 2 years, or 1 year next year, or 10% for the third year, or 15% or 20%, depending upon the, that is, analyst, depending on the expert's opinion, the contract cost is also most important. These are all the different techniques of costing, important techniques of costing. These are also most important. That then service costing, service contract costing, each and every word having its own meaning. Process costing, process, job, particular job, process, activity, n number of activity. Any activity for that, you take an example, any activity for that matter. If you go to visit hotels, then raw rice to, or raw material to food, ready-made food, it take its own process. Each process having its own income, having its own cost. Here, contract costing, each contract. Then service costing, service. You to hire a vehicle, that is service. Because today service sector play a major important role compared to other sectors. Service sectors, service costing, today it is more important, because due to busy the schedules and because less time for humans, because we don't have time. Therefore, service costing is most important today. More than 60 to 70% that costing, we call it as in the process, we call it as in service costing. It costs service costing. It is used to determine the cost per unit of service rendered. Cost per, for example, I am going to hire vehicle. I need to travel Mysore to Bangalore. Yes, that cost per unit, Mysore to Bangalore, what is that unit of that particular cost? Or, for example, in any organization, any activity for that matter, services. In take an example, after that finished goods, service costing come into existence. We need to sell the goods and service to the public. Advertisement cost, then services. What are all the in the ingredients? What are all the essentials of to flow or move from manufacturer to that is ultimate consumers, that is service cost. It is used to determine the cost per unit of service rendered. Because in case of that is process of goods, that is it may be producer to wholesaler, wholesaler to retailer, retailer to sub retailers, then ultimate consumer, shops and ultimate consumers. There are n number of stages are there. These cost, wholesaler to retailer, retailer to sub retailers, and it depending upon the goods and services. This service costing is also most important. These are all the most important, that is types of, that is process of costing. Then marginal costing and break-even analysis in decision making. Marginal costing is also one of the important techniques of, that is costing. Marginal cost is the change in the aggregate cost due to change in the output by one unit. That is marginal cost. Here we have seen two important costs: fixed cost and marginal cost. Fixed cost, I will give you example regarding fixed cost. The cost of the, for example, machinery, because fixed cost is concerned if you produce goods and services or not, maintenance of that building and machinery, that is fixed cost. Electricity, we call it as a lighting, and other things we call it as an, that is fixed cost. Then marginal cost, if you produce one unit, that is cost incurs. One unit cost, raw materials and power consumption and other labor cost, that is one unit is rupees 5 rupees. One unit for 5 rupees. That is marginal cost. We call it as a marginal cost. If you produce 20, 5 into 20, 100 rupees. That is marginal cost, 100 rupees. If you go for producing marginal cost, processing of one unit, it incurs 5 rupees. Marginal cost incurs 5 rupees. If you go for producing 10, 5 into 10, 5 into 10, 50 rupees. 50 rupees. That is marginal cost. That is the marginal cost is a change in the aggregate cost, aggregate 50 rupees, change in the total cost due to change in the output by one unit. One unit 5 rupees. If you go for 10, 100 rupees. If you go for 20, 200 rupees. Like that. That is we call it as a marginal cost. Marginal. If production is increases, the cost is also increases. Fixed cost, if the company go for producing the goods or not, goods and services or not, that the fixed expenses, security expenses, electricity expenses for, because lighting, because some machines are we need to computer lab, we need to maintain in AC room. That is electricity power and electricity. Then supervisors. Then if you go for activity or not, that is we need to incur, the company has to incur, the business have to incur fixed expenses. That is the difference between fixed expenses and marginal expenses. Variable cost. Marginal cost is also nothing but variable cost. Then it is computed in situation where the break-even point has been reached. It is computed in the break-even situation, break-even point. BEP means no profit, no loss. Break-even, no profit, no loss. I will show that. Yes, format of marginal cost. Here, particulars, amount, that is inner column and outer column. Sales, outer column, that is rupees. This is the pro forma of marginal cost statement, that is marginal cost statement. Here, particulars, amount, less sales, outer column, less variable cost or marginal cost. Variable cost is also nothing but marginal cost. Then under that, variable cost, direct material, direct wages, material we needed for production of production process. Then direct, that is direct material. Not indirect material, we are not going to consider that. Direct material, direct wages for that employee, direct expenses for that process, variable overhead, other overheads, marginal overheads or variable other overheads, That is, we call it as an variable cost or marginal cost. Sales minus marginal or variable cost is equal to contribution. We call it as an contribution. Sales minus variable cost or marginal cost. Variable cost or marginal cost, it may be direct material, direct wages, direct expenses, variable overheads, etc. These are all called marginal cost or variable cost, and that sales minus variable cost or marginal cost is equal to contribution. We call it as a contribution. Contribution minus fixed cost is equal to profit. Fixed cost, I already explained that. Fixed cost means if the company go for producing goods and goods and services or not, but company has to incur some fixed expenses. That is, we call it as a fixed assets. Contribution, sales minus variable cost or marginal cost is equal to contribution. Contribution minus fixed cost is equal to profit. We will get the profit. This is the pro forma of marginal cost or variable cost statement. Yes, formula for marginal costing. Sales is equal to total cost plus profit or variable cost plus fixed cost plus profit. Sales is equal to, sales includes is equal to means it includes total cost plus profit. Total cost plus profit is equal to sales, or variable cost, because three components we have seen here. One is variable cost or marginal cost plus fixed cost plus profit is equal to sales. I hope you understand that. Sales means sales includes total cost. Total cost means variable cost and fixed cost. Total cost is nothing but variable cost and fixed cost. Variable are nothing but marginal cost or fixed cost. Then plus profit. We call it as a sales. I hope you understand that. The next one, variable cost. I already explained that it changes directly in proportion with volume. If the volume increases, 1 unit 5 rupees. If it increases 20, 25 100. It changes proportionately, directly. It changes directly in proportion with volume, increases volume. That is variable or marginal cost. Then another formula, sales minus variable cost is equal to fixed cost plus profit is equal to sales minus variable cost. Then fourth one, contribution is equal to sales minus variable cost is equal to contribution. This is the formula. We need to understand, we need to practice this formula that is available in our study material. You please practice that, otherwise it is very difficult to solve the problem. Without understanding this concept, it is very difficult to solve the problem. Therefore, here we need to understand that. Then break-even analysis. Break-even analysis means no profit, no loss analysis. Or point. Break-even point means no profit, no loss. The sales of the particular goods and services, the sales of the particular year goods and services is 100 rupees. Then the expenses is 100 rupees. But it includes all the expenses include that is 100 rupees. Then sales is also 100 rupees. No profit, no loss. That is break-even point or break-even analysis. The point break-even analysis, the point where sales or revenue equal expenses. Sales or revenue equal expenses. The point where sales or revenue equal expenses. Equal. The expenses is, sales is 100 rupees or expenses is 100 rupees. Then the revenue is 100 rupees. Expenses 100, revenue is 100. That is BEP. Break-even point. Yes. The next one, the point where total cost equal to total revenue. Total cost is the point where the total cost equal to total revenue, we call it as a break-even point. BEP, no profit, no loss point. No profit, no loss. No profit, no loss. BEP means this most important concept in marginal costing, BEP, break-even point. No profit, no loss point, we call it as a BEP. Break-even point is equal to fixed cost or contribution per unit. BEP is equal to, break-even point is equal to fixed cost or contribution per unit. We can call it as a break-even point, where contribution is equal to What is that? Selling cost minus variable cost is equal to contribution. Fixed cost is equal to contribution minus profit is equal to fixed cost. This is the formula most important to solve the problems on break-even point or analysis. The next one, budget and budgetary control. Yes, what even by budget? We know that the budget is a blueprint of a plan expressed in quantitative terms. Quantitative terms in the sense the money measures in terms of money. Quantitative terms. That is the meaning of that. Plan. Budget is a blueprint of plan. Blueprint for next year. This year we need to prepare a plan for next year sales, purchases, any activity for that matter. We need to plan properly. Therefore, planning is most important. Budgeting and budgetary control. How to control that? Then the next concept of budget is a plan of action for the future period. That is a plan of action. Plan for next year or future period. That is nothing but the meaning of budget. Then budget is a financial plan expressed in quantitative and monetary terms. Every transactions, budget is measured in terms of money. It may be 10 crores, 1,000, 50,000, 50 crores budget. You take an example in budget, local, last class I explained that budget is concerned. That is local government is also prepare a budget. There we have two important concept you have seen in budget, expenditure and income. What are all the expenditure we need to incur and what are all the incomes, probable incomes we need to generate. That is the budget quantitative terms, that is measured in terms of money. Then it is prepared for a definite period. Yes, particular year, not haphazard. This year, for 5 months, 3 months, not like that. This is a definite period, and it includes planned revenue, planned expenses, planned assets, planned liabilities, and planned cash flows. This is most important in budgeting. Everything is planned. Every activity that should be planned properly. Otherwise, it is very difficult to make the profit, achieve the goals of the organization. Therefore, this budget is most important concept. Then what do you mean by budgetary control? Control means there are n number of controlling techniques are there. What are those n number of controlling techniques? It is essential for policy planning and control. Policies, the rules and regulations are there. Companies Act of 2013 is there. Old Companies Act of 1956. As per the rules and regulation, accounting and rules and regulation, we need to plan that budget as per the guidelines and rules and regulation of the accounting, as per the accounting concepts and conventions. Essential policy planning. N number of policies are there. N number of techniques are there. N number of rules are there. As per the rules and regulation, we need to prepare a plan and control properly. Controlling is most important aspects. Then it is next concept, that is it has become an essential tool for the management for controlling cost and maximizing profit. The purpose of the existence of business itself, how to maximize the profit, that is the motto of that. So in the present scenario, because social entrepreneurship is also, we have seen the motto, the purpose of the social entrepreneurship, not only making profit, but also for the self-satisfaction and welfare of the society. That is also a beautiful concept. But budget, that is also planning is most important. Minimum profit is most important for survival of any organization, for survival of any institutions. Without that, it is very difficult. BEP point, it is of no use. Existence itself, that is null and void. If it is no profit, no loss, what is the use of that? Yes, in that context, maximizing profit, the most important, the concept of budgetary control is to maximize profit and controlling all the cost as far as possible to control the cost. That is the budgetary control techniques. It is a proper planning policy, with the help of that, how to control properly and how to maximize the profit. That is the meaning, and that is the concept of budgetary control. Then forecast. The word itself says that. Forecast means it's a probable event. Today we prepare for tomorrow's activity. That is a proper planning, because I need to travel tomorrow, Mysore to Bangalore. Yes, I need to prepare. I need to plan properly where I should go. What is my assignment in Bangalore? Proper planning. Otherwise, that is forecasting. I need to prepare today itself. I need to plan properly where, at what time I need to, that is, leave Mysore and reach Bangalore, and what are all the activities I need to attend in Bangalore. These are all the, that is, forecast. Today I need to prepare forecasting of all the available resources, because resources are available in the organization, company. How to utilize that available resources effectively and efficiently, that is for proper probable event, that is next tomorrow's event, how to that is forecast properly, that is forecasting is most important for that. Then on the base of the time, budget, types of budget, on the base of the time, that is short-term budget, long-term budget, and current budget. There are three types of budget. Then on the base of the function, production budget, sales budget, purchase budget, labor budget, cash budget, selling and distribution overhead budget, flexible budget, master budget. These are all the different, that is, types of budget on the basis of the function. Then first category on the basis of the time, short term, long term, current. What is the meaning of this? What is the meaning of short-term budget? Short-term budget means it may be, that is, 1 month or 2 months, or depending upon the significance of the activity, we go for that. That is short-term budget. It depending upon the activity, particular activity. If you go for short 1 year, as usual, 1 year budget, short-term budget, it is as usual, particular accounting period, that is budget, we call it as a short-term budget. Long term, it may be the contract. You take an example, contract costing. It may be 5 years, it may be 7 years, it may be 10 years, long-term contract. Current, because today or tomorrow or 1 month or 15 days or 5 days, current budget. Today, now budget, current budget, day-to-day budget, we call it as a current budget. And these are on the base of the time. Then on the base of the functions, production department. Production, you have seen in organization, we have seen the production department. That production department has to budgeting properly available raw material, and how to utilize that raw material, FIFO method or LIFO method, or how to, when how many employees are required, what are all the wages of the employees, what categories of employees are most important here, mid-level management, top-level management, or lower-level management, and what is the cost of that. If he uses top-level management or mid-level management, what is the cost of that? Everything is most important here. Production management as manager. Therefore, in all the departments, the organization recruited specialized person. The person who was specialized in production department, production activity, we recruited as a production manager. He knows that how to reduce the cost, how to maximize the profit. Therefore, production management, the specialized person we recruited, organization recruited, production department. That production budget is most important. Then sales budget. After that, finishing of goods and services, then selling of goods and services. Selling of that particular goods is most important. Therefore, here is also sales department. We recruited, the organization recruited expertise in sales, how to stimulate sales. There are n number of techniques are there, marketing techniques are there. Then how to stimulate sales, how to increase the sales. It is the duty of the sales department, and sales budget is also most important. Then purchase department, budget properly. How to purchase, when to purchase, where to purchase, how much to purchase, what is the cost of that purchase. Today it may be 5 rupees, tomorrow it may be 20 rupees. Yes, purchase details, the purchase budgeting is most important. There it may be short-term budget, or it may be long-term budget, or it may be current budget. Then labor budget, because each and every activity, labor activity, that incur cost. Therefore, what is the actual requirement of the particular activity? Labor budget is also most important. Cash budget, day-to-day activity, we need cash. Cash flow statement, yes, cash. What is the requirement of the cash? If you retain liquid cash more, what is the, because ratios are there, standards are there. Because if you retain that cash in the form of liquidity, that is also affect the profit of the organization. Therefore, cash budget is properly budgeted cash. Then selling and distribution overhead budget, selling of the goods and services, the department, selling and distribution department, because what are all the duty of the selling and distribution of the goods and services, that overhead budget is also most important for that. Because a flexible budget, because flexible budget, we have seen that that is flexible, either it may be 10% or 5%, depending upon that flexible budget. That is also we have to prepare that master budget, that is also prepared with that basis, on the basis of the function. Master budget is also most important for activities, particular activities. Then next slide, I will move on to next slide. Yeah. Yes, meaning and definition of accounting standards. Meaning and definition of accounting standards. Yes, accounting standard. This is most important. I explained that. Accounting standard is a guideline for financial accounting. That is income and expenses, assets and liabilities. Income and expenses, that is income statement. Assets and liabilities, that is position statement. Accounting standard is a guideline for financial accounting, income and expenses, assets and liabilities. Yes. Next, the gap. Generally accepted accounting principles is comprised of a large group of individual accounting standards and widely accepted as appropriate to the field of accounting. That is generally accepted accounting principles. Why? We have seen in the global scenario, we have seen that is 195, that is more than 200 countries we have seen, each country having its own accounting standards. In our country is also Indian accounting standards is there. Therefore each country having American accounting standards, Indian accounting standards, Japan accounting standards, each country having its own accounting standard. Therefore these general gap is most important. Why gap is most important? That is because today we are in global era. Globe is in one village. Any business, any businessman start, any company can start business in anywhere in the globe. In that context, therefore gap is most important. This is a large group of individual accounting standards, each country having its own, that is accounting standards. How to generalize that? Because Japanese company that is started branches in Mysore or India, that is entirely, that should be preparation of books of accounts not only come from Japan. Our own people, they can start prepare the books of accounts because it is very difficult. In that context, this gap is most important, widely accepted as appropriate to the field of accounting. Everyone accepted throughout the globe. Gap accepted, the account accepted the accounting principle, gap accounting principles accepted. Okay, the next one, accounting standards are necessary. Why it is necessary? Because of we are in global era. Therefore, that is standards are necessary so that financial statements are meaningful across a wide variety of business and company. Because we have seen wide variety of wide countries, wide variety of business, each business having its own significance. Activities it differs. Service sector activity is entirely different from manufacturing activity, purchase activity, each and every like that. Then, therefore, these accounting standards are more essential in the global scenario. Then, list of accounting standards here, disclosure of accounting policies, AS1, because you have seen that is also available, these information available in our study material. Accounting standard 1, disclosure of accounting policies. Accounting standard AS2, valuation of inventories. AS3, cash flow statement. That is 4, AS4, contingencies and events occurring after balance sheet, after the balance sheet date. Then AS5, net profit or net loss for the period items and changes in accounting policies. Is depreciation account 6, 7, construction contracts, 8, revenue recognition, then 9, accounting for fixed assets, 10, the effect of changes in forex, foreign exchange rates, forex rates, then 11, accounting for government grants, 12, accounting for investment, then 13, accounting for amalgamation, 14, employee benefit, 15, borrowing cost, 16 is segment reporting, 17, related party disclosures, 18, accounting for lease, 19, earning per share, 20, consolidated financial statements, 21, accounting for taxes and incomes, 22, accounting for investment and association consolidated financial statement, 23, discontinuing operations, then 24, interim financial reporting, 25, intangible assets, 26, financial reporting on interest in joint venture, 27, impairment of assets, 28, provision contingent liabilities and contingent assets, then 29 financial instruments recognition and measurement, 30 financial instruments recognition and measurement, then 31 financial instruments presentation, 32 financial instrument disclosure and liability vision, revision to accounting standards. Yes, these are all the and other accounting standards is also there. We need to add that some more additions are there. We need to add that because our syllabus is old. Therefore, I stick on to is 32. Then concept of IFRS. The concept of IFRS, International Financial Reporting Standards, because we are in global era, therefore IFRS, International Financial Reporting Standards, are most important. IFRS is a principle-based standard. It is a principle-based standard. The principle-based standards have distinct advantage that the transaction cannot be manipulated easily to that is achieve a particular accounting. It is not. It is a distinct advantage that the transaction cannot be manipulated. IFRS cannot be manipulated easily to achieve a particular accounting. Then the IFRS, the Financial Accounting Standards Board, FASB, USA is having a convergence project with the International Accounting Standard Board, IASB, and is broadly adopting the principle-based approach instead of rule-based approach. Principle-based, that is most important, instead of rule-based approach. Then IFRS lay down treatments based on the economic subsistence of various events and transactions rather than is their legal. Here, the most important thing is that is economic subsistence of various events, transaction rather than legal forms. And also, the application of this approach may result into events and transactions being presented in manner different from their legal forms. Then lastly, to illustrate, as per ES 32 preference shares that provide the mandatory redemption by the issue are presented as a liability. These are all the significance and importance of that is IFRS, International Financial Reporting. Yes, the stage one, IFRS, stage one, there are three stages are there. IFRS implementation procedure in India, IFRS, International Financial Reporting Standards implementation procedure in India. There are three stages are there. Stage one, IFRS impact assessment. Second stage, impact. What is the IFRS impact assessment? That is most important because that is International Financial Reporting Standards. IFRS impact is most important. Then stage two, preparation for IFRS implementation. That is, we need to accept it because we are in global era. We are in the context of global business scenario. Therefore, we need to accept it. Preparation of IFRS implementation. Stage three, implementation and follow-up is most important. Implementation, follow-up. These are the most important stages of that is international financial reporting. Then convergence of IFRS with Indian perspective, that is subject IFRS and Indian Gaap, generally accepted principles. Components of financial statement, the statement of comprehensive in IFRS, that is components of financial statement. In IFRS, statement of comprehensive income statement of cash flow, notes to accounts, statement of changes in equity in case of IFRS. In case of Indian GAAP, comprises of balance sheet, profit and loss account, cash flow statement, and note in accounting. Then format income statement, IAS, Indian Accounting Standards, one that is prescribe the format of income statement according to the GAAP. According to the format prescribed by Schedule 6 to the Companies Act 1956, Banking Regulation Act for banking, etc., exempted for Level 3 the SSS Regulation Act, Banking Regulation Act, Bezel Banking Regulation Act. Then statement of cash flows, that is mandatory for all entities, which exempt from Level 3 entities from prescribed by ICWA. Then depreciation rates allocated on a systematic basis to each accounting period during the useful life of the assets. Then depreciation is, in case of Indian GAAP, depreciation is based on the higher estimate of usual life of the asset and the rates prescribed by Schedule 6 of the Companies Act of 1956. Yeah, next one, that is IFRS. IFRS comparison statement of IFRS with Indian accounting standards. Yes, accounting standards. Because different concepts are there. Here, title of the standards IFRS, title of the standard, that is AS accounting standards. AS 1, presentation of financial statement. Here, that is AS as per the AS, disclosure of accounting policies. These are all the different concepts we have seen in the, that is international financial reporting standards. Yes, thank you very much for your patience listening.